This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Erik Townsend and Patrick Ceresna.
MacroVoices episode 436 was produced on July 11th, 2024. I'm Erik Townsend. Variant Perception CEO Tian Yang returns as this week's feature interview guest. We'll discuss the leading indicators and why Tian says a curve steepener is the trade to put on here.
And I'm Patrick Ceresna with the Macro Scoreboard week over week as of the close of Wednesday, July 10th, 2024. The S&P 500 September futures were up 175 basis points, trading to 56.88. The melt-up of the Mag 7 continues. We'll take a closer look at that chart and the key technical levels to watch in the Postgame segment. The U.S. dollar index down 33 basis points, trading 104.98. The August WTI crude oil contract down 212 basis points, trading at 82.10. We'll take a look at that chart in the post game, and Erik will have the EIA inventory data. The August RBOB gasoline down 385 basis points, trading to 250. The August gold contract up 42 basis points, trading to 23.79, strengthening back towards its all-time highs. But will we see a breakout of 2400? Copper up 155 basis points, trading to 460. Uranium up 53 basis points, trading to 85.95. And the U.S. 10-year Treasury yield down 6 basis points, trading to 429. The key news to watch this Friday is the core PPI inflation numbers. And next week, we have the Empire State Manufacturing, retail sales, and the ECB monetary policy statement. This week's feature interview guest is Variant Perception CEO Tian Yang. We will take a deeper look into the macro conditions and the political landscape going into the elections. Erik's interview with Tian Yang is coming up as MacroVoices continues right here at MacroVoices.com.
And now with this week's special guest, here's your host, Erik Townsend.
Joining me now is Tian Yang, CEO and Head of Research for Variant Perception. Tian prepared a slide deck to accompany today's interview. Registered users will find the download link in your Research Roundup email. If you don't have a Research Roundup email, it means you haven't registered yet at MacroVoices.com. Just go to our homepage, MacroVoices.com, click the red button above Tian's picture that says looking for the downloads. Tian, I have to tell you, I was a little bit taken aback by the title of your presentation, Reduced Left and Right Tail Risks. Hang on a second. I mean, you guys have had some fabulous calls, and I take everything you say seriously, but I've kind of been feeling like this was a time in history that was increased risk, not decreased risk. Are we talking about a different perception, a variant perception of risks in the world right now, or are we just talking about a difference between market risks and global political risks?
Yeah, well, that's a fantastic question. And many thanks for using the variant perception a phrase there as well. So if we look back over the past kind of, 18 months, take it back to the beginning of 2023, the question today clearly is we've had terrible leading indicators. Ultimately, has the recession been delayed or has it already happened? And where do we go from here? So I think the main thing we've been grappling with is at a headline level, it's been very hard to see much evidence of a genuine recession, right? We all know kind of, labor market data has been okay, consumer data has been fine. And certainly, especially in the past kind of 6 months, a lot of very credible people, BCA, a lot of, strategists I admire have been talking up recession risks. So, I'm not blind to that. But the one thing that's probably given me a bit more comfort is I think after digging around in the data, we found a lot of evidence that the areas where there should have been a recession, where we should have seen the stress, there has actually been the stress, right? And that's a lot of what we cover in this deck. So, for example, micro businesses, if we look at kind of non-financial, non-corporate operating margins, they went to all-time lows, right? it looks like what you would expect in a recession. Looking at things like consumer credit card debt, very high delinquency rates, right, 10% plus on the Fed's data. So again, that's where the recession's been. The issue this time has been that normally historic, manufacturing recession and so forth. But historically, what you would normally expect to happen is when you get these stress kick in, they create more negative feedback loops that feed into a more broad-based slowdown that gives you like a proper kind of widespread recession. And I think that's been the difference this time around, where because of the ongoing fiscal deficits and quite a few kind of quirks of the cycle, we've just not had the negative feedback loops we would expect. And now you pretty much have lead indicators starting to recover across the board on things we look at. So we think manufacturing is going to get better. We think the consumer is okay. So it feels to us like the window in which those negative feedback loops should have kicked in, they're being somewhat alleviated by the very large and persistent fiscal deficits we've seen. The government's driven job creation. It's helped to prop up corporate profits. And obviously there's well-known things like, a lot of people locked in mortgages at lower rates. So even today, a new first-time buyer might be paying 7% for mortgages, but the effective mortgage rate is still only 3.8% on the stock of existing mortgages. So, household debt service ratios are still fine. So I think before I would have been pretty concerned that, lead indicators, is this the first time ever in history they're just wrong? But I think the areas where a recession should have happened, where the impacts should have been, like credit cards, like micro businesses, like manufacturing, we have actually already seen the recession. And so that gives me a bit more comfort that the recovery in lead indicators we're seeing is probably real.
Where does inflation fit into this whole story?
So I think our lead indicators do suggest inflation has a upward bias, but a lot of it's being discounted in market prices, I think already, right? If we look at the price action in yields, in the STIR markets this year, we've taken out a lot of cuts already. I think that this is a thing we discussed last time. I think we connected on MacroVoices. So I think from here, our point estimate kind of 6 months forward is that inflation is probably running at a 3.5% annualized rate, which definitely is high and probably a little bit high for the Fed. But the good news is a lot of the leading data for inflation, things like, the NFIB price plans, the ISM price plans, the fiber leading, a lot of data we look at, they basically peaked and started kind of rolling over a little bit. So it kind of gives you comfort that maybe, the right tail isn't actually that big on inflation. And even the San Fran Fed's own kind of studies on whether inflation is supply or demand driven, I think they've shown recently a lot of the supply factors are being diminishing as well. So overall, it feels like inflation is a little bit uncomfortably high for the Fed, but we don't think enough for them to hike, and probably at a level that allows them to do kind of a hawkish cut, right? Like we've been seeing, how this easing cycle globally is going, right? The ECB did that, the hawkish cut, and we suspect a lot of the G10 are going to go for that as well. So I think it's for sure a risk we need to keep an eye on, but it kind of feels like that inflation scare is probably kind of peaking and petering out.
Now, where does Variant Perception see inflation going from here? Because we've had every imaginable view on this program, from people telling us that we're headed back toward deeply negative interest rates to others saying, look, inflation has already bottomed. It's only going up from here. Is it one of those extremes, something in between? Where do you see this going long term?
I think, especially in investing, disagreements are often an issue of time horizon. So I think if we can be explicit on the time horizon, it might add a bit more clarity. So I think for us, we think of the world as kind of tactical, cyclical, structural. So structural is kind of 2 to 3 years forward. Cyclical is kind of 6 to 12 months business cycle, and tactical is kind of next 1 to 3 months, right? The next few data prints. So I think structurally, 2 to 3 year outlook to us is pretty unambiguous that inflation risks are to the upside. This is linked to a lot of our age of scarcity type thesis where, we think credit will be scarcer, labor will be scarcer, commodities will be scarcer, right? So structurally, we do think there's an upward bias to inflation, but obviously that's a very structural setup. Cyclically, I think we're probably at the point of just peaking. The leading indicators have been going up, but a lot of the leading inputs are starting to roll over. So more likely than not, we're kind of settling in this, 3.5 kind of annualized rate for a bit. But I think tactically, that's when everyone's going to be pretty focused, right? And here, it kind of feels like the market's somewhat gone ahead of itself a little bit. At the beginning of the year, everyone's super skeptical on the inflation scare. Everyone's focused on shelter CPI going lower and so forth. Whereas now, it feels like those underlying factors on things like shelter, on things like wages rolling over, that's still valid, but nobody's talking about that anymore. And we seem to be starting to be more worried about kind of short-term inflation scares, right? So it kind of feels like on a tactical, cyclical basis, we would probably err on the side inflation is no longer going to be as big of a problem, which again links back to my earlier point. Most likely there's room for kind of a hawkish cut from the Fed. The market is pricing 1.5 to 2 cuts from the Fed by year end, and then basically 4 cuts by mid-year, right, next year. So that feels about fair right now, given the outlook.
We've had some people suggest that any cuts at all at this point don't make sense. The Fed has basically boxed itself in by setting market expectations so that everybody thinks a cut is coming. Maybe they have to, go through with it in order to fulfill their promise. But it seems like, we're not headed back towards 2% with inflation starting to back up again. Is there still a rationale for any cuts at all?
I think the way we've been trying to approach it is there's not enough data to justify kind of an aggressive easing cycle, right? Like a standard, once they start cutting, they keep cutting kind of thing. That's only going to happen if there's like obvious, recession type stress, which I think we don't think is that likely right now. But in terms of doing like one cut and stopping, I think there's probably enough there to justify them doing that. Like, one thing I look at quite a lot to figure out like anchoring in terms of levels is the 5-year forward real OIS. So effectively, like that's like a market implied R star, right? Where real neutral rates should be. And that's trading around 1.5% right now, which is pretty close to our kind of central estimate. If you look at the various Fed Reserve regional Fed estimates, the range is like, 70 basis up to like 2% plus, right? So that's kind of the range we're talking about for where R star probably is. So in that sense, it feels like the pricing seems okay, right? Like we don't seem that far away from where that needs to be. So certainly you shouldn't expect a massive deviation in terms of Fed policy unless some kind of shocks kick in, right? So for me, I think the trade right now, the start trades, the front end isn't that interesting anymore compared to the beginning of the year. The way we're trying to position is ultimately now getting to like 210 steepness and those kind of things. Just because if you look at where 210s forwards and these things are, they're still pretty inverted. So they're still, it seems unlikely that 210s 1 year forwards are going to be realized, right? In terms of still being inverted. So I think that's probably where the divergence is between market pricing and the kind of underlying economy.
Now, if I'm not mistaken, this inversion that we're in right now has persisted longer than almost any other inversion on record. So it seems to me if you're going to make continuing predictions about it can't last much longer, you've got to have some explanation or understanding of why this one was different from others in the past. What's your perspective on that?
I'm a lot of times looking at the forwards rather than just the spot. So for sure, if you look at treasuries, 210, spots being inverted, like you say, for 8 donkey's years. But obviously the market is a forward-looking mechanisms, and there's obviously a lot of shifts in the curve, right? So when a lot of times the way we try and approach fixed income is look at where the forwards are trading. So 210s kind of 1 year forward in the swaps market was actually uninverted at the beginning of the year. And if you look at 210s 2 year forward, right, these tend to be pretty, they're already uninverted, right? So a lot of times our approach in fixed income is to look at where these forwards are, look at the macro, and think about, is it reasonable for those forwards to be realized or not? And then that's kind of guiding the trade. So it's not so much the spot alone, because obviously one of the major issues has been the carries being horrific, right? To put on a steepener. It's like the widowmaker trade, if the Fed doesn't cut instantly. So I think the timing works out a little bit better if you try and use the forwards to help time the entry of the trade.
And of course, the opposite risk is that if we were to go the other direction in terms of policy, that the trade wouldn't work at all. What is the time frame that you expect this 210 steepener to be profitable? How far can it go in the other direction before you decide it's a bad idea? What are the risk parameters on this trade?
Yeah, I mean, like I say, it's been one of those things, right? Certainly because of the carry, the concern, I think it's not that clear to just, put it on and park it. I think for us, it's a case of in the coming kind of weeks and months, the inflation scare probably peters out. The market is a bit more reassurance that the Fed could cut if need be, but they won't be in a rush to cut. But then the economic data holds up a little bit better. So that probably gives the chance for the trade to perform a little bit. But then obviously, if we start getting more like election news, we might get the kind of bad kind of steepening, right? The bear steepening. We saw a little bit that after the Trump-Biden debate. So the idea is that if we start getting any kind of risks of a sweep by one party or another, they pretty much demonstrated everybody wants to keep going with fiscal. Everyone's happy to keep spending money. And so that might also encourage a bit of a steepening as well. So I think it's kind of probably the main way we want to position for the second half. But certainly to your point, I think if the inflation data doesn't start rolling over, if inflation leading indicators start going up, that'll be, the concern. Like a nice way to pair the trade in a way is also, we've had on these Aussie flatteners for a while, because on our models, Australia's kind of should be the most hawkish central bank as they should have been since the beginning of the year. So in a way, like, if you're legging it out, that might add a bit of a natural offset, right? To the extent you have an Aussie flattener and then a dollar steepener.
On page 5, you bring in manufacturing recovery. What's the story there?
Yeah, so this is actually pretty interesting. So there's so many distortions linked to COVID. So one of the big distortions has been the kind of bullwhip effect being exaggerated and delayed. So, we all remember in COVID, there was big supply chain issues. So inventories were fully run down across kind of the supply chain, and it's taken a while to refill. So as a result of that, you've had this like very elongated inventory cycle bullwhip effect where customers ran down their inventories fully and then slowly rebuild back up. And so that's kind of normalized now. And the way you kind of track that is by looking at ISM manufacturing inventories versus customer inventories. And that's kind of the top right chart on slide 5. So as that normalizes, it kind of suggests the distortions are over. So now there's a chance for like a more standard inventory rebuild cycle, which kind of suggests to us that the manufacturing cycle is probably bottoming out. Now this is a key indicator for this cycle, because it would have kept you from being too early in predicting a manufacturing recession, right? In the kind of, Q3, Q4 last year, when there was a little bit of excitement on some of the kind of ISM new orders to inventory ratios and stuff. So yeah, I think this is a pretty key indicator. So it feels like that there's scope to have a kind of more bog standard normal inventory cycle. And so we're likely past the worst in manufacturing.
The charts on page 6 take us to the credit aspects of this. What's the story there?
Yeah, I mean, the key chart is the bottom right there, right? Where you can see the mortgage rates that first-time home buyers need to pay, i.e. more than 7%. But if you look at the effective mortgage rate on the existing stock of mortgages, it's still 3.8. And that's basically the story of why I think it's been hard to get, or why the headline data hasn't looked that recessionary. Ultimately, a lot of households locked in low mortgages. And so these only reset very slowly. Obviously, they are resetting as time goes on and as rates go up, stay up here, but it's not been that big a reset. And so as a result, debt service ratios are being manageable, right? And not really spiked higher, even with all the Fed hikes. And that's been like a big feature, kind of preventing the worst excesses in terms of like, a typical deleveraging cycle. And by the way, obviously, this is pretty unique to the US, right? Because of, these 30-year mortgages. When we look at countries like Canada, where, it's a lot more floating mortgages, 2-year, 5-year, their like household debt service ratios have like exploded higher, right? And they've clearly had a much more of an economic slowdown. So I think the point here is that the mechanism in which a credit deleveraging is supposed to feed into recession hasn't worked fully as you would expect historically. the areas that were exposed, so, consumer credit card delinquencies, those things have deteriorated, but mortgages have been fine. And now lending surveys and stuff, as we see here, right? The SLOOS lending surveys and everything is showing easing lending standards. So again, it feels like that window for these negative feedback loops to kick in, it has probably shrunk.
Tian, the chart on the bottom right kind of speaks to me from the standpoint that a doubling of the interest rate that consumers pay. This is not an obscure financial ratio that only finance guys pay attention to. We're talking about how much it costs to have a house to live in, pretty much doubled for most average people recently. What does history teach us about the effects of that? There's a lot of psychological effects, obviously. People feel like, well, surely the rates are going to come back down, aren't they? Back down to 0%. They're going to wait for that for a while. What is this going to do to the market that everybody's shocked by this doubling of rates?
So I think there's two aspects. So one, I think you're 100% right in the sense that clearly if rates stay up here, then over time that will feed through as people refinance. And ultimately, as those expectations or hope that rates go lower slowly die away, right? That's clearly like a lack of margin of safety for a lot of balance sheets. And certainly that's been the theme in terms of smaller businesses, micro business, right? Like if you couldn't issue IG debt, you've been forced to pay up for loans. So certainly that's a risk. But the problem is you can't look at that in isolation. There's also like an income sided equation, right? Because ultimately you are servicing your debt from cash flow and from your income. And so one of the main features of the cycle has been that the government, the US government, the fiscal deficits, the fiscal generosity that's on net pumped in, the 6-7% of GDP into the private sector, basically on an annualized rate. That's helping to prop up incomes and preventing this feedback loop where incomes drop, which then means that people can't service their debt, which means that, they have to obviously cut their expenditure, cut their activity, which then in turn feeds into even lower incomes. That's the mechanism that hasn't been allowed to work just because the government has been so proactive in using fiscal policy and also in driving job creation linked to fiscal sectors, right? In terms of, if you look at a lot of the jobs created since 2023, bulk of it is actually being in things that are either directly government or linked to government. So I think that's the thing. Yes, if this carries on, this credit thing is definitely a weak point, a point of vulnerability. And if you get income shock into this, then it will be bad. But I think the challenge has been that we haven't really had that income shock this time around that we normally would have seen.
Page 7 says micro business risks have likely already peaked. What kind of risks are we talking about?
The big conundrum for me has been, why have profits been so good? Why have the non-financial corporate profit margins held up? Right. All these things you would expect to see a slowdown in, it hasn't happened. And so we've been kind of scouring for evidence of, well, where has the pain been? And so this top left-hand chart here, it shows you non-financial, non-corporate businesses, right? And it's a pretty chunky amount. It's all the sole proprietorships, partnerships. I think it's a reasonable proxy for smaller businesses. And so the red line is the operating margin basically for these guys, right? And it's updated to Q1 24. So that's where the pain's been. You see the collapsing operating margins for these guys. That's where the recession has been. That's who suffered from, high interest rates, right? The economic slowdown or the leading indicator stress. But what's very interesting is if you look at the black line, net income margins have actually held up. And if anything, gone up, which is just it shouldn't really make sense, right? And the only reason we can find has potentially, again, all roads maybe come back to fiscal. So if you look at the top right-hand chart there, the government has basically not really been collecting taxes at the rate they should. And I think that's provided the buffer for a lot of the private sector to avoid a kind of income shock that they would have had to, right? If you look at the top right-hand chart, that shows nominal GDP against taxes on production. So there's a capital gains tax in here. There's no, income tax. This is purely taxes on production. So historically, it should be super correlated, right? Because clearly taxes on production should reflect in GDP. And after COVID is when we've seen this big gap where nominal GDP is being high, but the taxes have not been, and the government hasn't really collected. And, there's various series around it in terms of either expiry of, or like the ongoing kind of support from COVID policies. It could be, green tax credits, and, there's various things linked to that, right? But regardless, this gap is there. And we also see this divergence between net income margins and operating margins. So it kind of suggests that there has definitely been operational pain, but it's been somewhat buffered from ultimately really damaging the bottom line. And maybe that's why, if you look at the bottom left here, micro businesses, right? Small businesses, they've had very elevated job openings since COVID, which kind of suggests for some reason they still want workers, right? If they were really in a recession and stress, you would expect they don't want to be hiring anymore, but job openings remain super elevated for these smaller businesses. By the way, it's a very different picture for bigger businesses. So putting all this together kind of suggests that small businesses had the operational recession, but they've kind of come through it for now. And as wages start to slow, as kind of interest rates peak, potentially, the worst is kind of over here as well.
Page 8 moves on to housing headwinds. What's the story there?
Right now, we've talked a lot about certain aspects of the left tail being cut off in terms of consumer labor market micro businesses. But equally, it's not like obvious signs that we're going to get a bonanza economy, right? Like a really nice post-recession kind of, post-COVID style massive recovery. And ultimately, if we look at certain key sectors like housing, it's still not doing that great, which is why I think we framed as both the left and right tail actually being cut off somewhat. And so it feels like an environment where it's just kind of muddle through steady. And then if market pricing gets too far away either side from that, then you want to take the other side. That's kind of what it feels like. Of particular concern is building permits have drawn down and are ticking a little bit lower again. That's not great. Housing starts, shrinking again. That's not great. So there's still definitely areas of risk to keep an eye on. And it's fairly clear, right? If mortgages have surged, new buyer, new build demand isn't going to be as high. So clearly this area isn't going to come back as fast. So even though the kind of households are being insulated from the credit stress of rates going higher, it's obviously helping to defer home builder activity a little bit. So this is a genuine risk, and therefore we would frame as, it's actually cutting off the right tail a bit on growth as well.
Now, your firm, Variant Perception, has an excellent reputation for the work you do with leading economic indicators, many of them of your own design. What's going on with the LEIs? You got on page 9, it says sideways growth LEI.
So obviously it's been a pretty interesting environment the past 18 months that's, driven, some pretty volatile moves in the LEI. But as of right now, you can see the point estimate for where we think kind of growth is going to be is 1.8. That's kind of 6 months forward. But what's been interesting is that our recession regime has not really fallen away on the US because, with the fiscal, it's been a pretty distorted regime model for a while. So when you put it all together, it's not that easy to draw a definitive conclusion, but it's basically a bunch of mixed signals that it probably nets out and it probably goes sideways. And one way we try and explain it is a little bit like using the kind of the GDP now, because obviously that gets a lot of headline attention, but it's pretty volatile day to day and week to week. So one thing we like to do is we try to extract the kind of core components of GDP from that GDP now estimate. So basically private consumption and private investment, both residential and non-residential private investment, right? And we take those components, put in a 3 months moving average, and that gives you a sense of the underlying picture of where the economy is. And that's basically the red line in the bottom left chart. So yes, like the GDP now has a tendency to spike higher and lower as data updates, but the core underlying message for the kind of main private sector of the economy is the red line is basically making higher lows and marginally higher highs, right? So that's why it kind of feels like somewhat sideways. It's not bonanza, but it's kind of okay. That's kind of what it feels like.
U.S. presidential election is coming up in November, and you're bringing that into view on page 10. What's the story there?
Yeah, so we're not going to pretend to be kind of political experts, and obviously these things get harder and harder to forecast as time goes on. But I think we might have even hit it on it last time as well. So a framework we like a lot is the Keys to the White House framework by historian Alan Lichtman. obviously we can all see the betting odds, right? And, the polling and stuff, but he has a somewhat differentiated approach where he essentially says we should think of elections as purely a referendum on the past. So elections are either change elections or continuation. So if people are happy with the past 4 years, they'll just vote for continuity. And if people are not happy with the past 4 years, they vote for change. And you shouldn't bring too much the personalities into it and the policies into it, which obviously, with Trump and Biden, it's obviously a very extreme version of trying to prove if this works. But the basic idea is we want some quantifiable measure of the past 4 years and be like, okay, on net, did people's lives improve or not in aggregate? And if they have, it's more likely than not people go for continuity rather than change. And so it is very, very close at a nationwide level where it's marginally in favor of a continuation win right now. So i.e. the Democrats are supposed to win. And when we dig into like the kind of swing states, again, in terms of economic improvement, which we define as kind of real GDP per capita growth, again, for most of the swing states, it has actually improved in the past 4 years. So that would again suggest, again, purely from an outsider checklist point of view, this kind of continuity change election point of view, the Democrats should have a slight advantage. That said, obviously, like the Biden and Trump, like the debate has been a pretty shocking event. I mean, to be fair, so we'll see what happens, but at least this gives you kind of an anchor independent of kind of the specifics of the situation. So yeah, maybe Biden gets replaced. If it does, it kind of suggests the underlying conditions are good for the Dems, and that the surge by Trump right now might not come through. But obviously, there's still a few months to go. We'll see. But I think it's interesting because the betting odds and the polling is obviously now diverging from this framework, whereas before the debate it was pretty much aligned.
It seems to me that this particular election might actually be unique in the sense that there's so much uncertainty late in the race as to the potential of maybe one of the primary candidates being replaced. I can't remember any presidential race in my lifetime where this late in the race, there was a very distinct possibility that one of the main candidates, the top two guys, might be taken out of the race completely. I don't know if we have another example like that. Is there anything we can draw from, or how do you adjust your models for this completely unprecedented uncertainty of who's actually running from the Democratic side?
Yeah, well, I think it's like you said. I don't know how you model it, right? I mean, people said Reagan was too old. And he was only like 69, I think. So we're in like somewhat uncharted territory. But I think regardless, the way I'm trying to think about it is, what are the impacts, right? If things play out fine, or if things play out, with the worst outcomes, like what would happen? And I think most signs still suggest that a steepener probably makes sense, right? Like, if anything, when you have increased uncertainty, I mean, it feels like Trump's kind of, I guess, somewhat known entity, right? The only question is whether Biden's, mental, some of those things, is enough to sway the election into a sweep election. So, if we get a sweep election, it's kind of suggesting more fiscal policy. So, risks of bear steepening. If not, we probably just carry on. So that's probably the framing. I wouldn't necessarily be taking, I think, it doesn't make sense to take huge risks into it. Like we saw with the French election, right? Obviously, we're recording this July 9th. A lot of these things is probably the more uncertainty you have, the more it's kind of a buy the rumor, sell the fact type situation where the market tries to trade a theme into it and then it basically unwinds into and around the event. So that's probably more likely what happens. And so it's a case of just keep sticking with the underlying trade themes that make sense. Rather than putting all your eggs on the election outcome, I would say.
On page 11, you're bringing into focus benign earnings outlook. What's the story there?
Yeah, I mean, to be honest, there isn't a huge amount of story, right? We know like S&P large caps have rallied a lot, but the underlying data suggests that earnings outlook is good. So there isn't a huge amount of divergence right now, I think, between the equity market and what lead indicators or the earnings outlook says. So there's obviously a lot of temptation to say that equities look extremely overvalued, the AI bubble, but it doesn't seem like an obvious an obvious short. Like, the divergence isn't that big. So yeah, that's probably the thing to say on it. I think there's pockets of interesting things in equities. So, we like things like Brazilian equities, which are being absolutely hammered. It's just coming off like an LPPL crash climax. So like, there's areas that are more interesting to go into, but in aggregate, it's also not obvious that you want to be either pressing overweights or going to a big underweight, right? It just feels like, keep a neutral outlook probably makes most sense.
Let's move on to the US dollar on page 12.
Yeah, so I think at the beginning of the year, a long dollar trade was more obvious, a lot more contrarian, whereas right now it feels like it's starting to flip around, whether from a positioning point of view, our various tactical models, and even kind of our longer term, 12 months forward, fundamental edge models and these things, right? It's starting to show like, things are starting to roll over for the dollar. So, as I mentioned, I think a bit earlier, like we still like long euro expressions. We think European growth lead indicators are kind of recovering pretty unambiguously. Pro-cyclical European trade kind of makes sense. So in that sense, we're still kind of positioned for like a long euro short dollar, which was trade theme we initiated after Powell spoke at the beginning of May. It's been pretty choppy, obviously, because of the French elections. But again, buy the rumor, sell the fact, and the kind of euros come back a bit now. So I think this broadly fits into that. The top left-hand chart is pretty interesting, like, the city pay index, the various measures of positioning FX, and, it shows people still positioned pretty long the dollar, rather surprisingly. So that does suggest some room to kind of unwind the dollar long further.
Let's move on to commodities on page 13.
Yeah, so I think the structural story still hasn't changed on commodities. Still, we're still very bullish structurally on commodities, on supply constraints, energy constraints, all those things. The main difference has been that China's growth outlook and leading outlook has been pretty weak year to date. And so the rally at the beginning of the year was very much, I think, an unwinding of the recession trade from last year. And it was more positioning driven and rather than fundamental driven in a way. And so we've had that kind of short covering rally. We had the big jump, and then the underlying Chinese data hasn't come through. So commodities have rolled over a bit. And from now, we're starting to get more tactical models starting to align again since the start of July to go long commodities. So it kind of feels like there's probably not a huge amount of edge now given the year-to-date recovery, but the bias would be to err on the side of buying dips in commodities and positioning that way. But I don't think it's hugely compelling for now. Like the China data continues to look pretty bad. So I think you've got a lot of negative headline risks around China. But the good news is China looks like somewhat of a lonely outlier among most economies we track. Most economies are seeing growth lead indicators recovering. So there should be a fairly broad-based kind of stabilization to recovery in most global economies. So ultimately that should be okay for commodity markets. But the negative headline risk around China is going to still be around for a bit. So it kind of feels like trade with a long bias, buy dips on some bad China news. But yeah, it's probably more just, again, maintain your core commodity allocations. But we ideally want to see a bit more stabilization in China before being a bit more full-blooded on commodity long again.
And finally, on pages 14 and 15, you've got your variant perception heat maps showing us both for growth as well as for inflation indicators where the action is. Talk us through what's going on.
Oh, yeah. This is effectively like just a quicker way for clients to visualize and also to help us find where the outlier trades might be. So just to clarify, these are levels. So it shows you the level of growth and the level of inflation. But obviously, what also matters is kind of the rate of change. But the main thing to highlight is just how much of an outlier China is on both growth and inflation leading indicators, right? It's terrible. It's like really bad reading when most others are seeing inflation tick up or growth back to more neutral or certainly improving. So that's still the big theme. So again, you would expect RMB depreciation pressure. So, they're going to have to manage a depreciation. The PBOC is going to have to manage that. So I still think that that's like a really big thing that jumps out when you scan across. Other than that, again, I think something I've hit on before, just a little bit earlier, Australia still looks a bit of an outlier where Australia Inflation LAIs is still super, super strong. Australian growth is bottoming. So again, the RBA looks to be kind of the most hawkish within the G10. So obviously, we have various trades linked to that. So it's things like long Aussie CAD and things like that are still a way to express that policy divergence.
Tian, let's tie all of this together now. You mentioned a steepener. Is that the primary trade that you're recommending here? Are there other trades that people should consider? And I know particularly you had a really amazing call on gold with your LPPL indicator. Any further indications on gold or any further indications on other assets from LPPL for that matter?
Yeah, so I guess overall portfolio-wise, so I think steepener is something we're looking to start adding and, legging into. Core portfolio is still long euro Swissy. In terms of what we're long dollars against is still China. So, long dollar, short CNH. And I think in equity land, long Brazil is pretty interesting to us. In fixed income land, I mentioned, Aussie flatteners. And actually, we also think UK is pretty interesting. That it feels like the relative pricing of Bank of England versus the Fed has gone a bit stretched. So we like betting on a kind of less hawkish Bank of England relative to the Fed now. So you can do that via SONIA spreads against sulfur spreads and those kind of trades. So that's kind of overall where we are. But I guess the marginal main thing is to, we want to take a shot at the steepener, the negative carry widowmaker trade for this year. But we think the timing is better now because the 2 stands forwards are really inverted. In terms of the LPPL model, so again, as a quick reminder, it stands for log periodic power law. It's really a trend exhaustion model that aims to basically screen for patterns of stop loss behavior, right? When there's widespread stop loss price action. And so, we've had it on gold before. I think, we had it on palladium last time I was on. The main live signal is actually like a 4-hourly on Bitcoin. That could be quite interesting. It's been working pretty well on some of the shorter time horizon on Bitcoin. So, to the extent you have clients who like to take a punt on these, that's the main one that probably is somewhat interesting to keep an eye on right now. But yeah, that would be about it. There's no major daily kind of LPPLs right now.
Well, Tian, I can't thank you enough for another terrific interview. I always enjoy our talks. Before I let you go, though, please tell us a little bit more about what you do at Variant Perception. It's a boutique institutional research firm that has a terrific track record, although I would say probably not as well known or well recognized as you deserve. Tell us a little bit more about what services you offer, what's on offer, and how our institutional listeners can get a hold of you.
Yeah, so variantperception.com, we think of ourselves as our edge is really in building models, being creative in how we build models and aggregate data, and trying to be empirical in our approach. And so ultimately that translates into various models of lead indicators for the business cycle, policy regime models, various tactical timing models, single stock scoring models, and so forth. So the way the clients interact with that is either via the research, via our portal, or via data kind of API feeds. So hopefully that gives a kind of overall sense of our focus on kind of model building and trying to model kind of the parts of the investment process that we think is repeatable and can be modeled.
We'll look forward to getting you back in a few months for another update. Patrick Ceresna, Nick Galarnik, and I will be back as MacroVoices continues right here at macrovoices.com.
Now, back to your hosts, Erik Townsend and Patrick Ceresna.
Erik, it was great to have an update from Tian. Now, joining us again in the post-game segment is Nick Galarnik. Now, let's get to that chart deck. Listeners, you're going to find the download link for the post-game chart deck in your Research Roundup email. If you don't have a Research Roundup email, that means you have not yet registered at macrovoices.com. Just go to our homepage, macrovoices.com, and click on the red button over Tian's picture saying, looking for the downloads. Now, Erik, let's cover crude oil, starting with the EIA inventory.
EIA finally printed a big drawdown this week, with crude oil drawing down 3.4 million barrels nationally, Cushing, Oklahoma drawing down 702,000 barrels, gasoline drawing down 2 million barrels, distillates was the lone build on the board at 4.9 million barrels, for a net petroleum drawdown of 500,000 barrels. U.S. production ticked back up 100,000 barrels to 13.3 million barrels, returning to the level it plateaued at. If memory serves, we got to 13.3 million before the pandemic, then got back to that figure after the pandemic. I don't think we've ever seen a weekly print of 13.4 or higher. If we did, it was only one or two prints. So we'll see if we get above that level, but we're back to the all-time high, I believe. So we'll have to see if it plateaus here or continues to move higher. Overall, we've seen a big $12 rally from a 72 handle at the bottom to an 84 handle at the top, corrected back down to an 80 handle. Now we're bouncing nicely off of that 21-day moving average down at 80.04, but still closed Wednesday well below the 5 and 8-day moving averages, which are co-located at 82.62 as of Wednesday's close. It's unclear whether or not the market can resume a rally above $85. I'm flat here and focused on gold and uranium.
You know, Erik, overall for me, crude oil has actually been behaving very well. It's now close to a month of trading above its 50-day moving average. It has beaten many Fibonacci zones of the April-May market correction. And so far, the dip has been contained above $80. And even though we could easily still have one quick little dip down towards $80, the longer the bulls keep this consolidation at good, healthy levels and defend the price action, the more likely it is to be a continuation pattern that might see crude oil make a punch toward $90 in the months to come. It'll be really interesting to see how that develops. Now let's get to the S&P 500. I want to get you involved in the conversation here, Nick. What are the levels you're watching?
Yeah, Patrick. So right now the spot price on SPX is approximately $56.30, and we have an implied move for next Friday's July 19th monthly OPEX at 70 points. Therefore, the upper implied move is 5,700, and the lower implied move is 5,560. Right now, we have no key resistance as we're at all-time highs, and we have key support at 5,500. And to note, there's a gap right now from July 11th at 53.75, which I think we fill in the next couple of months or so. But right now, we're up 4.85% in just a month, and I think we're seeing the blow-off top right now as we speak. I'm inclined to think that we see some downside coming after the July OPEX and into the September FOMC meeting.
It's interesting you say that because from a seasonality perspective, when we go into the latter part of the third quarter is the tendency for the market to have less liquidity and it tends to get heavier. And so it's interesting that the market is ripping this way. What's particularly interesting is while the S&P measures technically to move towards 5,800, and it's entirely plausible that it can head there on the very short term in this parabolic rise that we're witnessing on the markets. What is the underpinning problem is the fact that the breadth of the market is still very poor. Like we are still at 51% on the breadth indicators that we show on page 4, which is we were at 60% back in June, and in May we were at 65%, and in March we were at 85%. There's just a lack of participation. This continues to be solely the mega caps rallying. You know, Nvidia was up again. We had Apple ripping to all-time new highs, Google and Microsoft all pushing. When you have these super mega caps doing all of the work, then the market it lacks that breadth. And what we see is that at this stage, we're going to see these mega caps at some point run out of momentum. There's just going to be an upper ceiling of where the buying comes in. And the question becomes, can the market breadth widen to counter it? Or will we see a very deep mean reversion when we see those short-term blow-off tops? And just to kind of put context into that, Nick, is on page 5, I have that S&P 500 equal weight index, which basically equal weights all of the 500 stocks. And you can see we're nowhere near the June highs, nowhere near the May highs, and nowhere near the March and April highs. And so this rally, while it seems spectacular, is really just being driven by a handful of stocks, and that usually doesn't end well. And those are all Nasdaq stocks. So on page 6, I have that chart. Let's start off with your levels here, Nick.
So right now on the Qs, we have a spot price of approximately 503 with an implied move for next Friday's July 19th monthly OPEX of plus minus 10 points. Therefore, the upper implied move is 513 and the lower implied move is 493. Right now, we have no key resistance as we're at all-time highs, and key support resides somewhere around 485. Notes right now on the Qs are that we have a gap at 466 from June 11th, and that we're actually up since then by about 7.5% in just a month. And in the month of July thus far, we're already up 5%, where over the past 16 years, the Nasdaq has averaged a return of 4.64%. So I'm inclined to think that we see for the remaining month of July a negative return overall from this level, which means that perhaps selling bear call spreads out of the money, in my mind, is a decent idea. I'm also more inclined to look at the small caps as they haven't really done too much overall. So I'm bullish on small caps and bearish on big tech going forward.
From the technical level, the measured move on the upside of NASDAQ is about 2150. So I think that there's room for the short-term move to finish as we might see Apple approach 240. We could see Microsoft take a shot at 500. There could be a few more of these finishing moves, but at some point this market's going to get exhausted and we're going to see some mean reversion. Clearly on the short term, this thing just seems to be gaining traction on the upside. It'll be interesting to see where that turn point develops. Now on page 7, we have the volatility index, and what we continue to see is that the volatility remains at multi-month lows and is just sitting there in that pocket where you could be at this point pretty much ensuring your portfolio gains for an incredibly reasonable price. What are the levels you're seeing on the VIX?
So right now with the VIX sitting at around 13, we can expect intraday moves of about 0.75%. Now for the last month or so on the S&P, which correlates to the VIX, we've seen intraday movements on average of about 0.75%. So we've seen realized vol essentially in line with implied volatility. However, right now, insurance is extremely cheap going forward. And given that we have an election later this year, it would be very prudent for those portfolios that are heavily correlated to the S&P to look at hedging at this point in time.
All right, moving on, Nick, I wanted to just highlight the dollar index chart. And while it doesn't reflect that 60, 70 points that we're down in the post-inflation number, the dollar is just in a trade range muddle. And particularly noteworthy is that it's a mixed when you look at all of the cross currencies. And while the euro may generally be weak and the yen may be weak, the pound seems strong. The Canadian dollar and the Aussie dollar are surprisingly stronger than expected. And so you have a scenario where just there is very little clarity on the very short term technically on the dollar. I still do believe the dollar is poised for a meaningful trend move at some juncture, but right now there really is no sign of life here, and expecting this to remain range bound on at least the short term is the only call to make here.
And moving on to page 9, we have that gold futures chart. What do you guys think here?
Well, the technical outlook has changed slightly, but only slightly, from consolidation with a downtrending bias to horizontal consolidation with a potential to develop into a new uptrend. The trend of lower highs has broken. We now have a newer swing high coming off of a swing low that could have been a double bottom. I'm still hopeful for another puke down to 2250 to 2285, where I'll add to my longs aggressively if we get that opportunity.
Erik, I'm a little bit more bullish on gold here. The fact that we have consolidated for 2+ months in a very sideways range and trading virtually along its 52-week highs. We have the 2400 level ready for a potential breakout. What makes it that much more bullish for me is that silver looks really good. Platinum is turning back up. Palladium seems to have put in a bottom. The gold miners are working their way higher. So we have actually the precious metals market certainly taking some accumulation, and it'll be really interesting to see whether or not the bulls can hold a breakout above 2,400 in this post-inflation number.
Now, moving on to page 10, we have that uranium chart. Erik, what are your thoughts here?
Well, the big catalyst this week was news of a new tax on uranium production in Kazakhstan, which is where almost half of the world's uranium supply comes from. The new tax is expected to push global uranium prices higher. That might have been the catalyst to put a final bottom in this correction, which is now almost 6 months old. But frankly, I doubt it. The utilities are in no rush to buy on the physical market, and it's the dog days of summer with 0 pounds of physical uranium traded on most trading days. This market is coiled up and ready for a big move higher, but there's no reason for that to happen until the physical spot market for uranium starts to move with some real volume behind it. Right now, the physical market traders are all at the beach house for the summer. So it's anyone's guess whether this market looks ahead and starts to rally soon, or if we wait and see even lower prices through the end of August before this eventually turns around. One way or another, though, I expect the second half of 2024 to mark another big upleg in uranium and uranium mining shares. The question is just how long we wait for that move to start and whether we get an opportunity to add even more size to our longs if this correction deepens even farther from here.
Well, Erik, after an amazing 2023 run, the first 6 months of the year has just been one big uranium consolidation. We have now unwound the entire overbought state of this market, and we're starting to see it upticking. Now, will it be a meaningful breakout? We haven't seen the U308 yet confirm. Sprott is crawling off of its lows, but far cry from an official breakout, but we're seeing good accumulation in the uranium stocks, which are taking that news very well. So it'll be really interesting to see whether a start point for a potential new uranium move emerges here in the weeks to come. Finally, on page 11, I have that U.S. 10-year Treasury Bond. And while we have seen yields declining, especially here in the post-inflation number down to about 420, bonds continue to crawl higher. I'm watching the 111 level on this Treasury Bond. If we have a breakout there, we could easily come back to 113, 114, some of the highs we have seen in 2023. And while in the big picture, I'm not bullish bonds, I do think in this short-term environment going in to the tail end of the year, there is room for bonds to actually appreciate to the top end of their ranges. And so be interesting to see how that follows through.
Patrick, you started a brand new YouTube channel dedicated to financial and trading education. Tell us more about it.
Well, thanks for asking. Over the last decade, we had been publishing an array of free market analysis, technical analysis, and options opportunities, but we have always reserved our core education for our paying members. We have decided that it's time for us to start sharing some of our favorite nuggets of investing and trading education. So I launched my new YouTube channel at Patrick_Ceresna. We have a lot of positive feedback from a few episodes back when we discussed a few Bob Farrell rules of investing in the postgame. So I put together a short video going through all 10. I'm very excited to start sharing with those interested. We have the link in the chart deck in the Research Roundup email, or you can just search for Patrick_Ceresna on YouTube.
Folks, check it out. Patrick, what's in this week's Research Roundup email?
Well, in this week's Research Roundup, you're going to find the transcript for today's interview and the chart book we just discussed here in the postgame, including a number of links to articles we found interesting. So you're going to find this and so much more in this week's Research Roundup.
Well, that does it for this week's episode. We appreciate all the feedback and support we get from our listeners and are always looking for suggestions on how we can make this program even better. For those of our listeners that write or blog about the markets and would like to share that content with our listeners, send us an email at researchroundup@macrovoices.com and we will consider it for our weekly distributions. If you have not already, follow our main Twitter account at MacroVoices for all the most recent updates and releases. You can also follow Erik on Twitter at Erik S. Townsend, that is Erik spelled with a K, and follow Patrick at Patrick Ceresna. On behalf of Erik Townsend, Patrick Ceresna, and myself, thanks for listening and see you all next week.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Erik Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.